Hello and welcome back to Mr. C's Accounting, where we are looking at allocating partnership incomes and in more detail. So let's get to it. So we looked at a very basic division of partnership income last video, where the partnership was 50-50, but often partnerships won't be 50-50. If one partner were to bring, say, a building, cash, and expertise, and another partner brought cash and expertise, then, the partners might agree that the person who brings more gets more. So you might be looking at a 60-40 split. And I mean, really any option is valid. The important thing is that the way that we divide partnership incomes when it's not 50-50 is through income ratios. You may recall from the last video that I said that partnerships are formed after what's called a partnership agreement is signed. And in that agreement, partners, they agree to many different aspects as to how the business will be run, who does what, who provides what, and in this case, what the split of incomes or losses will be. And we use income ratios to govern that split. So if income ratios are not outlined in a partnership agreement, then the law states partners will split the income equally. So if they don't say anything, it's 50-50. If they do say anything and they sign an agreement, then we abide by that agreement. So, some common items that factor into partnership agreement with respect to income ratios include what's called a fixed ratio. So this is what I was referring to earlier. For example, 60-40 split, and that's it, and so we don't go in any deeper, it's just one partner gets 60%, one partner gets 40%, and it's usually decided based on what they bring to the table. The ratio is established when the partner agreement is signed. And I guess, so this is what I was talking about, if someone brings cash and a building and expertise. So something else, that's all capital investment, by the way, except for the expertise. Something else might be time and effort versus I don't know them. I have met them several times. Some acquaintance of mine own a hobby shop together. It's pretty cool business, actually. They've done quite well for themselves. But one of the partners, it's three partners. Now, the standard for three partners would be 33, 33, 33, and 0.333. But one of them can only work around half the time that the other people can. So, although this person did bring the equal amount of capital investment to the table. So, I didn't ask them what their split was. But in this case, since the guy isn't able to work as much, he won't get the same income ratio. He might, they're all friends, so they may have decided to just do it equally. But, in this case, it could be 40-40-20, 35-35-25. Who knows? It's up for the partners to decide. But these are the two main factors that usually govern what an income ratio will be. If time and effort devoted is equal, profit sharing ratios would be equal. Usually, yes. Again, there's many different circumstances. It all comes down to what partners decide. Capital balances. So this is another type of income ratio. So the first type was fixed ratio. We're into the second type now, which is capital balances. So this is a suitable method when amounts invested are considered to be important or the partners do not really work in the business. So often, especially with investments, you see this a lot on Dragon's Den, if you've ever watched Dragon's Den. For those of you who haven't watched Dragon's Den, what happens is someone who has a business idea, like there was one that it's actually really neat because you can see them in a store now. It's these mixers for beverages alcoholic and non-alcoholic. And they're made from locally sourced ingredients, and they come in these little artisan bottles, like these old school glass bottles with cork tops. Really cool, very trendy. The person who had the idea, had a connection to someone who could make the bottles, and they had all the equipment needed to make the actual syrups that they had. But they had zero knowledge or connections with regards to distribution. So basically, they could make a product, but they couldn't make it go anywhere, except for immediate stores surrounding where they lived and worked. So when they went to Dragon's Den, the Dragons really liked the idea. And when they were pitching their investments, one of the big factors was the person who came in wanted to partner up with a dragon who would not only give them the capital investment that they would need to get the business up and running on a larger scale, but would also bring the connections of distribution. And that's what ended up happening. So a silent partner is someone who brings an investment, and usually they bring in some kind of advantage. In the case of the example I've given you, it's their connection to distribution companies. So once they've paid their investment and once they've brought their expertise to the table, they don't do very much else. And that's called the silent partner, where that's what they do. They don't really interfere with how the company runs. They just provide an investment and usually some form of expertise or advantage along with them. Third kind is a combination of salary, interest, and fixed ratio. That's rather complicated, but partners receive a fixed salary. FYI, for those of you who don't know, owners of companies usually don't cut themselves a salary because, the advantage of being an owner is that once all your expenses are paid, all the profit goes to the owner. Now, depending on how the company does, this could either be a really good thing or a really bad thing. And insofar as partnerships go, they can cut themselves a salary if they wish. They can also gain an interest on their capital balance. So the more they invest, the more interest is returned to them. And then after the salary is paid and after the interest on the capital balance is paid, whatever profit is left over goes to the owners. And so this is just a way of controlling what owners get in a more rigorous manner. So it's just a higher level of control. It also means another reason why you might do this is if often when you're an owner, you want to reinvest in your company to help it grow or to make improvements or to just maintain things. And so by doing this, you can include in the partnership agreement that any additional income outside of these two things, whatever profit is left, you might decide that 50% of it goes to be reinvested into the company, to buy new equipment, to expand, whatever. But yeah, so this is just a higher level of control in terms of what happens to whatever money is left over. Okay, so salaries and interests in these instances are not expenses of the partnership. That's something to remember. Now, this pertains mostly to how entries are made. They're just used as part of the method to allocate profits amongst various partners. They're only used in the profit allocation calculation. A lot of Asians there. And the reason for this is that partners are not employees, they're owners. And so, as I was saying earlier, partners don't usually cut themselves a salary. And in this case, they are and they aren't. Like, the end result is that they are, but they're not actually, from an accounting point of view, cutting themselves a salary. This is used to help divvy up the profits, but we don't, under the salaries payable, for example, there wouldn't be the names of the three owners, if you know what I'm saying. Oh, and salary interest allowances paid to partners must be debited to the partners' drawings. So this all goes under partners' drawings, not salaries or expenses. So, for example, the Two Dogs accounting partnership agreement states the following. Salary allowance. Elway gets 40 grand, remember these guys? And Atwater gets 50 grand. So for whatever reason, Atwater gets more. Maybe he brings more to the table. Maybe he works harder. Who knows? So they get an interest of 5% on the capital balance at the beginning of the year. Now, the capital balance is their individual capital balance. Just FYI. The remainder is distributed equally, fixed ratio, 50-50. Oh, and in this example, net income is $150,000. So that's the amount we're working with. So the beginning capital balance, Elway has 100. Whoa, I don't know what that flash was. Sorry. So at the beginning of this calculation, the capital balances are equal. Elway has 100 grand and Atwater has 100 grand. If you remember, one of them, I forget which one, but one of them brought a building and some other equipment as a form of investment as opposed to just cash. I think it was Atwater. Anyway. So how do we allocate the $150,000 in income to the partners? So there are several steps involved in doing this. The first is to allocate salary allowance. So we do that first, and we've already established that $40,000 goes to Elway and $50,000 goes to Atwater. So before we do anything, we need to take note of this. Now, again, the salary isn't necessarily paid. It's just part of the allocation of the net income calculation. So we're not going to have an entry under salary expense to this effect. We're just using this as a method to calculate what the division of income should be. So that's step one. Step two is allocate the interest allowance based on the beginning capital balance. So they each get 5% and they each have 100 grand. So they both get $5,000. Again, this isn't necessarily paid out. You won't see an interest expense account for this. We're just using this to divvy up the net income. All right, so we've divided up, or we've written down our salary allowance and our interest allowance. Step three is to allocate the leftover income based on the fixed ratio. In this case, it was 50-50. So, now remember, if the ratio isn't 50-50, in this example, this is where things would start to be different. And they're already different in one respect, in that the salary allowance is different for the two gentlemen. There could be a different ratio here. It could be 60-40 or whatever. So, salary allowance is $40,000 for one, $50,000 for the other, gives 90. Interest allowance is 10 grand total. This equals $100,000. So what that means is that there's 50 grand left over that is allocated based on the 50-50 ratio. So they each get $25,000. And there's the calculation for that there. And therefore, so we've done, this is almost like hypothetical, except now we can actually figure out who gets how much. So in this case, Elway gets his 40 plus 5 plus 25. And Atwater gets his 50 plus 5 plus 25. So Elway gets 70 grand, Atwater gets 80 grand, and altogether that's 150 grand. So that's how our net income has been divided up. So, once we've done this, the entry to record the allocation of net income is, don't forget our income summary account. Again, this is just a temporary account used to sort of pour the income in and then take it out. So we have our income, we credit capital, and we credit a capital again. We split this up because we have, if this was a sole proprietorship, we would just have, the owner's name and it would just be one entry. But because we have two owners, we write down the split, which is what we just spent our time finding. And so this represents what's happened with the net income of $150,000. Note that if salary or interest were actually paid, then the following entry would have occurred. Whoa. Don't forget, we don't use salary expense for the partners because they're not employees. So if they each get a salary, it would be drawings for the one partner, drawings for the other partner, and then cash. Alternatively, if you wanted, you could do drawings for one partner and then cash for that amount, and then drawings for the other partner and then credit cash for that amount. You could do whichever you want. Just don't forget that if you do two debits and one credit, so debit Elway for 70 and debit Atwater for 80, then the cash would be the sum of the two, not just one. Okay. So, we're going to look at what happens when we suffer a loss now. So, everything's the same as before, except now there's a net loss of $75,000. Beginning capital balance is exactly the same. Elway has $100,000 and Atwater has $100,000. So, our two first steps are exactly the same. Sorry, my mouse has been glitching out ever since it broke. There we go. Well, I mean, it works, but it doesn't work as well as it used to. Anyway, so step one, Elway gets $40,000, Atwater gets $50,000. Don't forget the entrance on the allowance of beginning capital. So they both get 5%, and in this scenario, they both have the same capital of $100,000 apiece. So that's $5,000 each. So first two steps are exactly the same. Third step is also the same. So we have our total salary allowance and our total interest allowance is $100,000. However, because we're taking a loss at this point, the company, like $100,000 is taken out of our net income. Remember when we had our $150,000 income? We took $100,000 out of that, and there was $50,000 left over that had to be divided according to the fixed ratio. Now, in this case, we haven't made a net income. We've made a net loss of $75,000. So, in terms of salaries, we still pay that salary, hypothetically speaking. So in this case, there's a total negative amount of $100,000 plus $75,000. So a total negative amount of $175,000. We're losing $75,000 plus the salary and interest allowance that's in the partnership agreement. So whatever amount is left over is allocated by the 50-50 ratio. So in this case, Elway gets 50% of that, $87,500. Atwater gets 50% of that, $87,500. So the total net loss is split evenly. Now, it gets a little tricky here because part of this $175,000 is the salaries that they're getting, hypothetically speaking. But, oh God, sorry. But we reintroduce the salary as a positive as far as Elway's concerned, because from his point of view, he's getting $40,000 before anything happens. Now, in this case, he's getting $40,000 plus his $5,000 from the interest expense minus the loss that the company took. So his $40,000 plus $5,000 minus $87,500. Now, this is the same exact steps we took earlier, and the result is negative $42,500. These brackets represent negative in this case. Atwater gets his 50. Remember, Atwater gets a higher salary allowance than Elway does. So he gets his 50 plus the 5,000 minus the loss that they both suffer, the 87,500, which gives us 32,500 for Atwater. So because he is paid a little more, he suffers a little less, financially speaking. So, note that the salary and interest allowance must be allocated first in the income allocation calculation, regardless of whether there's a profit or a loss. So steps 1 and 2 are exactly the same, and part of 3. So at this time, the entry to record the allocation of net loss is, we debit capital by 42,500 for Elway. We debit Atwater capital, 32,500. Remember that last time when they were making money, we credited them the amounts. Since we're losing money, we're debiting them. And we credit income summary $75,000. So, remember in the last video I said the book has some great examples that are a little more complicated, which just show further application of the principles that we're learning about here. So check out page 613 for a tabular format of the income allocation calculations. Really useful stuff. It's a good idea to see it in a higher level of detail, so I highly recommend that you do that. But that is it. So, allocation of income, done. I will see you guys in the next video. Now, there's going to be 2 videos for the last lesson. They're small, they're short, but it's 2 videos for the last lesson. I'll see if I can put them into one. We'll see. Anyways, take care. Bye.